fortune won. Paradise must be won. Paradise must be won. Each day and each night, through darkness and through light, cry it out to the world. Spread the word.
أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم رب اشرح لي صدري ويسر لي أمري واحلل عقدة من لساني يفقهوا قولي نحمده ونصلي على رسوله الكريم السلام عليكم ورحمة الله وبركاته. Dear brothers and sisters, in the last episode we briefly touched upon the aspect of the corporate governance in the financial institutions. In this episode, we'll discuss a little more about that, and then we will move forward. About the corporate governance, we saw that the Western corporate governance or the capitalist corporate governance did not work. We were told that the conventional financial institutions are risk averse, and as we know that the Islamic financial institutions are labeled as risk-akin in a sense that they compromise on risk, which is not the case. As we go along, we will see that this is a myth and the reality is totally different. Now we talk about the risk aversion approach. When you talk about the corporate governance in the conventional financial institutions, we have many aspects: the capital adequacy ratio, the risk management tools, and on top of that there are the guiding principles given by the Basel I and then later on the Basel II. And also the other aspects locally, with the local central banks also apply certain regulations on their own areas. So we saw that a Western institution called Lehman Brothers, which used to take pride in declaring itself as Basel II compliant, 158 years old institution, came down crumbling like house of cards, despite the fact that the corporate governance was supposed to be excellent, despite the fact that this institution had been there for a very long time, and obviously it was very, very trusted. But anyway, the point that I'm trying to bring here is that the level of corporate governance in the Islamic institutions vis-a-vis the conventional, the regulation through which the Islamic bank is issued a license, the promoters of an Islamic bank, the founding shareholders, approach the regulatory authorities of an Islamic country, and then they submit their plan. It's a full feasibility study which is submitted, which basically has all the elements to tell the regulatory authorities that this project will be successful. And then once the regulatory authorities and the licensing authorities have given a preliminary approval, then the founding shareholders would do the IPO, and then they would also submit a list of the Sharia board members who actually would be selected to form the Sharia board. What is the Sharia board? What kind of body it is? The Sharia board, it is important that any Islamic bank selects the right scholars for constituting its Sharia board. And when we talk about the Sharia board, there is a misperception amongst a lot of people that the Sharia board in an Islamic bank is just an advisory body. It is not an advisory body, it is a supervisory body. It means that the Sharia board actually, ideally, it should be selected by the General Assembly, by the shareholders, because these are the shareholders who select the board of director members. So they constitute the board of directors. So the same shareholders should actually select the Sharia board members. And obviously, when they will select the Sharia board members, they will appoint the Sharia board as a supervisory body. And then it comes the board of directors. I'm talking about how an ideal Islamic bank should be. So look at the hierarchy: the General Assembly, then the Sharia board, and then the board of directors, and then obviously the senior management. Board of directors will appoint the senior management. They will not appoint the Sharia board members. It will be the AGM or the annual general assembly or the general assembly which will appoint the Sharia board. So this is an additional layer of corporate governance when it comes to the Islamic banks. The Islamic bank have the Sharia board, which the conventional banks do not have. So in conventional bank, it is the shareholders, then the board of directors, and then the senior management. Here we have the shareholders, and we have the Sharia board, and then we have the board of directors. In this case, there is an additional layer of corporate governance already embedded in the Islamic financial institutions. The board of directors in a conventional bank or any conventional financial institution or any institution for that matter which deals in finance has got the internal auditors who are independent of the management. They are directly reporting to the board of directors. The Islamic bank also has internal auditors. Internal auditors are directly reporting to the board of directors, fine so far, parallel to the conventional financial institutions. But another layer, the second layer of corporate governance we find in Islamic financial institutions, which is the Sharia auditors, which is not the case with the conventional banks. So the Sharia auditors are the auditors, which is in addition to the internal auditors and the group compliance people in an Islamic financial institution who are directly reporting to the Sharia board members. What is their role? Their role is completely different than the internal auditors. Internal auditors look at how a particular transaction has taken place, the risk element, the risk factor, and the security aspects, and whether the bank's rules, manuals have been followed or not. The Sharia auditors actually have a different responsibility. They actually look as to how a particular transaction has been executed, has been entered into the system of the bank. It means that if the Sharia board has guided the management or a business unit how to do a transaction, talk about the leasing transaction or a murabaha transaction or any other transaction, there are parameters for that. For example, in a leasing transaction, you cannot start your lease if you haven't first got the title and the possession to the asset. Because as per Sharia, you cannot lease something which you do not own. So you need to own something. So for that, you have to first sign the purchase contract, whether it is being purchased from a third party from the market or it is being purchased from the client itself, because purchase and leasing is an established product in Islamic banks. So if the Islamic financial institution has signed a leasing contract before signing the purchase contract, the whole transaction will be considered as void by the Sharia auditors, simply because you are violating the Sharia principles. Because Sharia says you cannot lease something which you do not own. So in order to comply with the Sharia principles, you first enter into the purchase contract first. You get the title and possession to the asset which is to be leased, and then enter into the lease contract. This is one example. Similarly, there are many examples that the Sharia auditors basically will look into and see how these have been executed. If these transactions have not been executed, any transaction has not been executed in a proper order, and as a result, the income which is being generated through this transaction is coming to the bank, the Sharia auditors will recommend in the report to the Sharia board that, well, this income has not been earned in a halal manner. What is halal? Means permissible. And what is the antonym of halal is haram, which is the non-permissible. So the Sharia board auditors will directly report to the Sharia board, not to the board of directors, and submit their report. And they will say that we have gone through a random checking, we have gone through different transactions, and we have seen that these are the transactions which have deviated the Sharia principles, which have deviated the Sharia pronouncement, and they have not been executed correctly. And as a result, the income which is coming out of these transactions should be discarded. What does this imply? It means that if the bank, Islamic bank, has earned certain income through those transactions which have not been executed in a correct manner, then that income will not go to bank's bottom line. It will have to be discarded and put into a charity account, because the depositors have trusted the bank's management, and the depositors have basically given their money in trust to the Islamic bank, so that the Islamic bank can invest in a halal manner, earn the halal return, and distribute the halal income to them. So if this Sharia auditors do not play any role, and if in any Islamic bank the Sharia auditors are not hired or not trained to go and check, then that Islamic bank may not be actually coming up to the expectations of the depositors. It means that the income which is going to the depositors may not be 100% pure. It may have some element of some non-halal income mixed into it. So this is very, very important for any Islamic bank, the management of an Islamic bank, to hire the Sharia auditors. And almost all the Islamic banks do have the Sharia auditors, which are directly reporting to the Sharia board. And taking this corporate governance further, when we talk about the Sharia principles being applied in a manner that the transaction should be executed in a correct manner, we mean that the funds which have been given by the depositors have correctly been used, and then the return which comes out has correctly been received and then correctly been distributed. So we're talking about the full circle, the entire circle which has been completed in a halal manner, and then the credibility of the institution will go higher. And that's why when we talk about the General Assembly, we actually would like the shareholders to come and to listen to the report which is given by the Sharia Board chairman. The Sharia Board basically prepares a report which is read out in the General Assembly along with the report which is read out by the chairman of the Board of Directors. So here we're talking about two additional layers of the corporate governance. There are other aspects of the corporate governance which we'll be discussing further. But here we're talking about, in a conventional bank, General Assembly takes place, the chairman, Board of Directors will read out the report, and then if somebody has any question, they will ask. Here we're talking about Islamic banks, the General Assembly, where the chairman, Board of Directors will read out the report, and the chairman of the Sharia Board of the Islamic bank will read out the report to the shareholders and say, this is the way your bank has operated. If there are any anomalies, it is his responsibility to read it out and say, shareholders, please take note of these irregularities. And then the shareholders may request the Board of Directors to apply some more controls to be able to remove those anomalies. So here we're talking about check and balance. The system of check and balance in Islamic financial institutions is much, much stronger and much, much effective than you can see in any conventional bank. The time has come to take a short break, and when we come back, we'll continue with the discussion. Please stay with us.
Spread the word of Islam.
Assalamu alaikum wa rahmatullahi wa barakatuh. Welcome back after the break. Just before going to the break, we were discussing about the corporate governance in the Islamic banks, and I was going to tell you about the Sharia board's role as to how to protect the interests of the depositors. In a conventional bank, we have learned earlier that the conventional bank will accept the deposits at a predetermined rate of interest and will invest those deposits by way of lending further down. And the interest rate at which the conventional bank will take the deposit will be lower, and the interest rate at which they will lend the money will be higher, and sometimes the gap becomes too much. So the difference actually becomes the profit or earning for a conventional bank. But whilst the conventional banks use their discretion to increase the interest rate anytime they would like to have it, like we saw recently in the Gulf countries, that the conventional banks, as soon as the crisis started biting, they started increasing their lending rates. So on one side, the depositors have been put at a certain fixed rate. On the other side, as and when the opportunity arises, the conventional banks keep on increasing their interest rate on their lending to the borrowers. Sometimes it really becomes back-breaking for the borrowers because they may not be able to manage that. They may not be able to afford to have this increasing interest rate, but because they are stuck, so they have to live with that. So when we talk about the interest rate in conventional bank, here we're talking about the fixed interest rate. Compare it with the Islamic bank's model. Islamic bank's model is that the Islamic bank will receive the deposits from the depositors on a trust basis. Islamic bank will receive the possession of the money, whilst the title of the money will remain with the depositors. So it means they are basically investing their equity. The Islamic bank will have share capital. They may have used the share capital to some extent in establishing themselves because, as I mentioned earlier, an Islamic bank must first establish itself as an entity before it goes to the depositors and say, I'm ready to be your mudarib. So it means that you have to comply with all the local regulations, the licensing authority regulations, the central bank or the Ministry of Finance or Economy, or any other local government regulations. So once you have completed all the regulations and everything, then you will say, okay, this is the Islamic bank we have established. We have the license from the regulatory authorities to start. And the shop is now open and we will welcome the depositors. Now, whatever you have done so far, you have actually been investing your share capital, and you have been setting up the branches, the head office, the infrastructure, hiring people. So some amount of the capital has been used. Whatever is the remaining amount of the capital will be invested along with the money which comes from the depositors. So there is a common pool, or it's a common pot, for example, where the depositors are putting their money and the shareholders are also putting their money. So depositors and shareholders are actually shareholders are also like any depositor. So it's basically a partnership between them, that they are investing their money through the common pool. Okay, so this is the common pool concept in the Islamic banks. Now, when we talk about the common pool, fine, depositors have put their money, shareholders, whatever little bit they can invest, they have also invested. Who will manage the common pool? When it comes to managing the common pool, obviously the depositors have brought their money to the Islamic bank because they cannot invest on their own, because they do not have the expertise to invest. This is their savings. If they had the expertise, they would have started something on their own. They would not come to the Islamic bank. So the Islamic bank is saying, we have the expertise, we have hired the people, we have the infrastructure ready, and we have all the paraphernalia of an Islamic bank readily available, and now we will start doing the business. So in this case, the money coming from the depositors basically will be the lifeline for an Islamic bank, because this is a great chunk of money, a big chunk of money. When you compare it with the money which is put by the Islamic bank, as a portion, as a ratio, it will not be more than 5 to 7% or maybe less than that. But 90 to 95%, this will be the depositors' money, which will basically be invested in the Islamic bank's business. So the Islamic bank has been appointed by the depositors while they are signing the deposit contract as a fund manager or the mudarib to manage their money for them so that they can get the halal return. So the Islamic bank actually has got two roles in the Islamic bank, the Islamic bank management or the shareholders. One is that they have invested their share capital, whatever is the residual after they set themselves up, into the common pool. And then the second one is that they are the managers of the whole common pool. It means their money gets completely mixed up with the money of the depositors and it becomes inseparable. And then from that common pool, the money is being taken out and invested here and invested there. In some cases, it is the sale contract, murabaha, istisna, salam, ijara. In some cases, it is the investment, for example, the mudarba or the musharka. Ideally, the Islamic banks have worked on a model whereby there's only one door through which they get the funding, which is the mudarba. It means they sign the mudarba contract with each and every depositor. And there are several doors through which the investment goes. And these several doors could be, as I mentioned, the sale contracts and the investment contracts. Earlier also I mentioned that when we talk about the conventional banking, which is almost 400 years old, we see that there is only one product that they are relying upon for the last 400 years. So there's a stagnation of ideas. And what is that one product? That one product is the loan with interest. For the last 400 years, all the conventional banks have only this product, which is loan with interest. When we compare it with the Islamic banks have got sale contracts, they have got investment contracts. And then there is a structuring, which is basically to combine two different contracts to make a third structure, which is suitable to the financing requirements of a customer. So we're talking about a stagnation in the conventional banking whereby they're relying for the last 400 years on one product, which is the loan with interest. And if you open the wrapper, inside this is the only product. If you talk about the personal loan, it is loan with interest. Car loan, it is loan with interest. If you talk about the trade loan, it is the same. Overdraft is the same. Credit card is the same. Project loan is the same. Bonds is the same. Go to the higher level, bonds, for example, is the same. So here, the product is only one, and only the wrappers are being changed. We talk about the Islamic bank, and we see that there is no scarcity. We have the investment contracts, and we have got the sale contracts. If I count, there are about 5 or 6 different kinds of investment contracts, and then there are different kinds of sale contracts. And then you can, for example, there is a project requirement. A project needs to be established, and the expansion of a project or a greenfield project for that matter. Obviously, one structure will not serve the purpose. So what we do is that we take 2-3 structures and we try to come up to the funding requirement of the client whereby certain funding is being done in certain manner. The return is coming out from another structure. So this is structuring is basically an art, and also at the same time it is science. Whereas we don't have this kind of activity, high intellectual level in conventional banking. Coming to the point, the corporate governance, the Islamic bank has established itself, business started, shop is running, the investment has been made, and then the returns are coming out to the common pool, and then we have got the common pool profit distribution. But before that, very important point which I would like to explain is that the role of the Sharia board in not only overseeing as to how the bank is being run in a Sharia compliant manner so that all the shareholders, all the depositors, and the employees also should get the halal risk. It means that the shareholders will get the halal return, the depositors will get the halal return, the employees who are working there also. So it becomes a big responsibility for the Sharia board to look at all the areas of Islamic bank to ensure that everyone is getting the halal risk. Thank you very much for joining us for this episode. We'll continue with this discussion, inshallah, in the next episode. Assalamu alaikum wa rahmatullahi wa barakatuhu.
Spread the word, oh man. Spread